Hey there, investors. Welcome back to the channel where we make complex finance stuff super easy to understand. Whether you're a newbie just dipping your toes into the investment world or a seasoned pro looking to refine your skills, you're in the right place today. We're talking about index funds, how to value them, why it matters, and how you can maximize your returns. So, buckle up, folks, because this is going to be a wild ride. But before we dive in, I need you to smash that like button, subscribe, and of course, share this video with your fellow investors. Trust me, your friends and family will thank you later when they start getting those sweet, sweet investment returns. Now let's get to it. Alright, let's start with the basics. What exactly is an index fund? Simple. An index fund is a type of mutual fund or exchange-traded fund, ETF, that aims to replicate the performance of a specific market index. Think S&P 500 or the NASDAQ 100 or even global indexes like the MSCI World Index. It's like a playlist of stocks that's already curated for you. You don't have to pick the songs, the DJ's already done it, you're just along for the ride. But instead of music, you're getting the performance of a basket of companies, and trust me, some of these baskets are more valuable than others. Now, why should you care about index funds? They offer broad market exposure, low fees, and historically strong performance. They're perfect for those of us who want to invest smart, not hard. Just set it and forget it. Well, kind of, but we'll get into that. Now, why should you value an index fund? Well, as with any investment, you need to know what you're getting into. You wouldn't buy a house without checking its market value first, right? It's the same with index funds. You need to understand if it's a good fit for your portfolio. You need to know what to expect in terms of performance, risk, and the underlying assets. You don't want to get stuck in a situation where your best investment turns out to be a bunch of overpriced stocks, kind of like thinking you're buying a Lamborghini but ending up with a Hot Wheels car. Let's make sure you're buying the real deal. So, how do you value an index fund? Glad you asked. There are a few key things you need to keep in mind when evaluating an index fund. These are the metrics that will give you an idea of whether it's the right investment for you. Let's break them down. First up, expense ratio. The expense ratio is the annual fee you'll pay for the fund to manage your money. This is a percentage of the fund's average assets under management, AUM. The lower the expense ratio, the better. Why? Because the lower the fee, the more money you keep. Now, I'm not saying you should only look for funds with an expense ratio of 0%, because let's be honest, we all know nothing's free in this world. But a lower fee is definitely a good sign that the fund isn't eating into your profits. A good range is anywhere from 0.05% to 0.2% for index funds. Next, we have tracking error. This is a measure of how well the fund is tracking its benchmark index. Ideally, you want the tracking error to be as close to zero as possible because that means the fund is mirroring the index it's supposed to replicate. If the tracking error is high, it means the fund is straying from its benchmark and you might not get the returns you're expecting. Imagine you're following a map and the fund is your GPS. A high tracking error is like your GPS saying, hey, I know you're trying to go to the beach, but how about we take a detour to the mountains? Definitely not the vacation you had in mind, right? Now let's talk about dividend yield. If you're investing for income, this is a metric you'll want to consider. The dividend yield tells you how much income the fund is paying out relative to its price. A higher yield means the fund is paying out more money, but be careful. It's important to check the sustainability of those dividends. Think of it like a vending machine. If you put in $1 and it spits out 10 quarters, that's pretty awesome. But if the machine's only giving you 2 dimes and you're still putting in $1, you might want to reconsider your snack selection. Alright, let's talk performance history. This is where you look at how the index fund has performed over time. Past performance isn't always a perfect predictor of the future, but it does give you an idea of how it's held up against the market over the long term. If the fund's been tracking a popular index like the S&P 500 for the last 10 years, and it's been consistently performing well, that's a good sign. But if it's been slacking and underperforming, you might want to rethink that investment strategy. Liquidity is the next metric you need to consider. It's how easily you can buy or sell shares of the fund without affecting its price too much. More liquidity means less risk when it comes to trading. You don't want to be stuck with an index fund that no one's interested in buying when you want to sell. Think of liquidity like a busy coffee shop. If everyone's buying coffee, you're going to have no trouble getting in and out. But if it's just you and the barista, well, good luck. Now that we know the key metrics, how do we choose the right index fund? It all boils down to your investment goals. If you want to grow your wealth, focus on funds that track major indexes like the S&P 500. which represents the 500 largest companies in the US. If you're looking for something more steady, bond index funds might be more your speed. Think of it like choosing the right movie for the night. Do you want a big, epic action flick, S&P 500, or are you in the mood for a chill, slow-burn drama, bond index funds? The choice is yours, just make sure you know what you're getting. So, when should you buy or sell an index fund? Well, generally index funds are a long-term investment, so if you're in it for the long haul you shouldn't be constantly buying and selling. Buy when you have a plan and are in it for the ride. Don't treat index funds like they're a new pair of shoes. You're not going to try them on every day and decide to return them. These are the comfy sneakers of the investing world. You want to wear them in for the long run. So there you have it. How to value index funds like a pro. I hope you're feeling more confident in your ability to analyze and select the right funds for your portfolio. If you learned something today, make sure you hit that like button, subscribe, and share this with anyone who could use a little extra help in the world of investing. Let's spread the knowledge and help everyone build smarter portfolios. Thanks for tuning in, and remember, investing isn't just about buying stocks, it's about making informed decisions. So, get out there, research your options, and happy investing.